there's this old saying, right, that the bond market is the singular source of truth, right, in general. And something that I've been hearing from guests that we've brought on the show recently is maybe there's some reason to think that the 10-year is not an honest a signal as it used to be. And there are a couple of reasons for why that might be, right? But it's basic. Maybe you might call it manipulation, or certainly more intervention by the Fed. We had a guy, Joseph Wang, who's the co-host of Forward Guidance with my colleague Jack Farley, who kind of outlined this pretty neat idea about pre and post Great Financial Crisis, right, where you had a bunch of regulation post GFC that forced big banks to buy up treasuries, which kind of distorted the pricing signal. I'd just be very curious, when you kind of look at the bond market and let's say the US 10-year in general, do you view it as an accurate pricing signal, or is it more distorted by intervention by governments, central banks, et cetera?
I think it's more the latter. It used to be more of the former, but and also, and with respect to the earlier chart, I think the yield curve, of course, is an X-ray of the market. How one of the deepest markets in the world, in fact, the deepest market in the world, the interest rates markets are looking at things, and the 2-year domain, of course, is the bank domain, because banks have liabilities that are typically saving accounts in the 2-year maturity domain, and 10 to 30 years is, of course, pension funds, mortgages. So that's an entirely different group or asset looking at the market, and so the yield curve gives you all those perspective in one line over time, also dynamically. So it's great, and sometimes it goes wrong indeed when you go negative. That almost always predicts a recession. However, lately things have changed a bit. So it used to be that the market participants, the banks, the pension funds, were giving their votes, if you will, by buying bonds, and you could read in the yield curve how they thought about the future. But right now, I guess. But maybe things are different in Europe than in the US. So I'm very interested in Jurrien's perspective as well. Right now in Europe, the central bank is one of the biggest buyers. In fact, they're in the whisper to be the only buyer, the one buyer. Those are the terms that you hear. So I guess even mortgages, 50% of all the mortgages are bought by the central bank. So
wow.
In that way, the central banks right now have very much control, not only over the short-term durations and their own Fed funds rates, but also over the 2-year, 10-year, and 30-year rates. So I guess if we go negative now, it's more like a little mistake or something of two departments not talking to each other. And but in the end, I guess the signal is less pure. The signal that the yield curve gives to investors is less pure now than it was before all the quantitative easing.
Yeah, I totally agree with that. And I don't think you have the chart on this, Mike, but I have a cloud chart which I can send to you. Maybe we can splice it in later.
Sure.
But that shows a scatter plot of inflation expectations through the TIPS market and nominal yields. And you can pretty clearly see how the Fed's asset purchases have created a situation of financial repression, and which last year, basically pulled the 10-year yield about 100 basis points below where it should otherwise have been. And actually, if you can pull up that bond chart that you had on before, that's a very simple bond model. It's not that one. It's the one with the green. Yeah, that one. It shows you how far below kind of my fair value band the 10-year yield got last year, right? So I have a very simple bond model that says, give me the 10-year nominal GDP rate, the Fed funds forward curve, and a demographic indicator, which in this case is the growth rate in the labor force, because demographics, I do think, drive interest rates very powerfully. And you can see this band, and the band is moving up because the Fed is tightening, and therefore the forward curve is being lifted. But we're kind of near what would be considered fair value, but a year ago we were well below it. And so I do think that that shows you the financial repression of the impact of asset purchases. And Plan B just mentioned, what the ECB is doing, and earlier what Japan is doing. I think Japan is a very good example because their demographic trends are about 10 to 15 years ahead of ours in the US. And Europe is a little bit ahead of us as well. And so demographic trends, aging, baby boomers in the US at least, I think are a very clear deflationary force, and that whatever inflation we're getting now has to offset that deflationary force. And so, the Bank of Japan owns half the debt in Japan, and it's buying half the supply on an ongoing basis, and it has completely tamed the bond market over there. The annualized volatility of long-term JGBs, Japanese government bonds, is 3 in Japan versus 11 here in the U.S. So it shows you where we might go in the bond market in the coming years. And if that happens against a backdrop of persistent inflation, which of course in Japan has not been the case, but in the U.S. maybe it will, then you can see how people are looking for real stores of value as a hedge against that.
Some of these statistics here are just absolutely nuts. So everyone kind of knows and has accepted some of the extreme monetary experimentation that the BOJ, right, the Bank of Japan, has kind of undertaken. Plan B, I wanted to ask you this, I didn't want to interrupt you, but did you say that the ECB is buying 50% of all mortgages in Europe? I mean,
That's correct.
That is nuts.
The same is true. Yeah, it is, and the same is true for bonds, right? Jurrien mentioned as well in Japan. I think it's the same in the U.S. that the biggest buyer, maybe 50%, I don't know in the U.S., but especially, the central bank is also buying equities, by the way. So we're going into that in the next topic, I guess. But yeah, it's a driving force, and it's a big problem. It's a very fundamental thing. There used to be a big division between the state and the central bank, but
right.
That division has become less and less because right now the government emits bonds, and the central bank is buying them with out of thin air, of course, and so the two are one in a way.
The Fed owns, I think, the Fed's balance sheet is, I think, 36% of GDP. The Bank of Japan's balance sheet is 128% of GDP. So if you think the Fed has already gone to extremes, you ain't seen nothing yet if you look at Japan.
Yeah, exactly that point, because in Europe is always somewhere in between. And as Jurrien said, the demographic component is very strong, and you can see that in the rates. You can see it in the balance sheets, the central bank balance sheet. It's almost like a powerful predictor of what's going to happen with rates.